Every year, someone predicts the Ottawa market is about to crash. And every year, someone else predicts it's about to boom. Both of them can't be right, and yet both of them keep getting clicks. So today, I'm going to give you a prediction dressed up as certainty. I'm going to show you the actual signals worth watching, the ones that tell you far more than any single forecast ever could. I want to be upfront about something that most people in my industry won't admit on camera. Nobody can predict this market with real precision. Not me, not the analysts, not the headlines. What we can do is understand the underlying forces well enough to make smart decisions despite the uncertainty, instead of waiting for a crystal clear forecast that's simply never going to arrive. By the way, thanks for joining me today. My name's Curtis and I'm a real estate agent with Lepage right here in Ottawa. Each day I help buyers and sellers just like you navigate the largest financial transaction of their lives. My contact info is on the screen now and in the description below this video. Now let's get back into it. So let's start with the forces that actually move this market, rather than the ones that get the most attention. Interest rates matter, obviously because they directly affect what buyers can afford to borrow. But rates alone don't determine the market, because affordability is also shaped by wage growth, by how many homes are actually available, and by how confident people feel about their jobs and their future, which is a much harder thing to measure than a rate announcement. Employment stability is a bigger factor here in Ottawa than a lot of other Canadian cities, and it's worth understanding why. Ottawa has a large, relatively steady base of government and technology employment, and that tends to soften the extreme swings that you see in cities that lean heavily on a single, more volatile industry. That doesn't mean this market never has slow years. It clearly has and will again, but it does mean dramatic crash predictions here have historically overstated what actually happens on the ground. Supply is the other half of the equation, and it's the piece that gets the least attention despite mattering enormously. When new construction slows down and existing homeowners choose to stay put longer instead of listing, available inventory tightens, and the tighter inventory tends to support prices even when demand isn't especially strong. Watching building permits and new listing volumes tells you more about where things are headed than watching the price headlines themselves. Here's a signal I personally watch closer than almost anything else, and that's the ratio of homes selling to new listings coming onto the market each month. In specific price brackets, not just citywide. When the ratio favors sellers, prices tend to firm up or rise. When it favors buyers, prices tend to soften or stay flat. This number moves earlier and more honestly than the average price headline, which tends to lag behind what's actually happening by a month or more. I also want to mention the psychological piece because it's real and it's underrated. Markets move partly on fundamentals and partly on collective mood. When enough people believe a crash is coming, some buyers pause, which can actually soften the market simply because people expected it to soften. When enough people believe prices are about to take off, buyers rush in, which can accelerate price growth simply because people expected it to accelerate. Predictions don't just describe the market, sometimes they quietly help create it. And so where does that leave us right now in honest terms? I describe this as a market in the middle of its cycle, not a dramatic extreme in either direction. Inventory has been building gradually in several segments, which has given buyers more breathing room and more negotiating power than they had a couple of years ago. At the same time, well-priced, well-presented homes are still moving at a healthy pace because solid demand hasn't gone anywhere. It's just becoming more selective about what it's willing to pay for. And if you're trying to decide whether to buy or sell based on where the market is headed, here's the honest advice I'd give a close friend. Waiting for the perfect moment usually costs more than it saves, because that perfect moment is only ever obvious after it's already passed. The families who do well tend to make their decision based on their own life circumstances and treat market timing as a secondary factor, not the deciding one. I also want to address something specific too right now because it's on a lot of people's minds. Rate changes over the past couple of years have shifted what buyers can afford, and that's had a real visible effect on activity in certain price points. But rates move in cycles too, and looking at a home you can genuinely afford today, rather than waiting for a rate environment that might never arrive exactly the way you're picturing it, tends to be a more reliable path for most families. So if you take one thing from this video, let it be this. Anyone promising you certainty about where this market is headed in either direction is selling you confidence, not accuracy. The better approach is watching the real signals, inventory, the sales to listing ratio, employment stability, and making a decision based on your own life and your own numbers, not on whichever headline felt the most dramatic this month. I'd also want to talk about how different price brackets can move in a different direction at the very same time, because this trips up a lot of people trying to make sense of a single blended market number. Entry-level homes might be holding steady or even climbing because there's simply a more demand relative to what's available at the right price point, while the luxury segment softens because there are fewer buyers able to stretch that far right now. A single citywide average smooths all of that into one number that doesn't actually describe any specific buyer's actual experience. Geography plays a similar role, and it's worth understanding before you assume a citywide trend applies evenly to your specific street. Areas with new transit access, new schools, or major employers nearby often move somewhat independently off the broader market, sometimes holding value better during a slower period, sometimes appreciating faster during a stronger one. So if you're trying to understand your own situation, the trends in your specific pocket of the city usually matter more than the citywide number ever will. I'll also say this because I think it needs saying plainly. Trying to time the exact bottom or the exact peak of this market is a strategy that sounds smart in theory and almost never works cleanly in practice. So it's even for people who do this professionally full-time, with access to far more data than any individual buyer or seller. The bottom and the peak are only ever obvious in hindsight, months after they've already passed, which is exactly why waiting for the right moment so often turns into waiting far longer than anyone originally intended. So instead of chasing a perfect entry point, I'd encourage you to build a decision around your own timeline, what you can comfortably afford today, and what you'd actually need out of a home right now, and not what the market might theoretically do over the next year. That approach tends to hold up far better over time than trying to outguess a system that's even professional forecasters get wrong, more often than they'd like to admit. Years from now, almost nobody looks back and regrets buying a home they could genuinely afford in a neighborhood that fit their life, simply because the market moved a little further in one direction or another afterward. What people do is regret putting their life on hold for a year or two, waiting for perfect conditions that, in hindsight, were never actually coming in the clean, obvious way they'd imagined. So if you want to talk through what these signals actually look like for your specific situation, your neighborhood, your price range, your timeline, I'm happy to walk you through the real numbers with you, honestly, without trying to talk you into anything either way.